Welcome to our CFP Exam Prep podcast, focused on employee stock options. Today we're diving deep into ISOs and NQSOs, two crucial components that frequently appear on the CFP exam. Let's start with the fundamental difference between incentive stock options and non-qualified stock options. ISOs are employee-only benefits that receive preferential tax treatment, while NQSOs can be granted to anyone and are taxed as ordinary income. Understanding the tax treatment of ISOs is critical for the exam. When an employee exercises an ISO, there's no immediate regular tax liability. However, and this is where many test takers make mistakes, the difference between the exercise price and fair market value is subject to alternative minimum tax calculations. The real tax benefit comes when selling the shares. If you hold the stock for at least 1 year after exercise and 2 years after the grant date, any gain qualifies for long-term capital gains treatment. Now let's break down NQSOs. The taxation here is more straightforward, but that doesn't make it less important for the exam. When exercising NQSOs, the difference between the exercise price and fair market value is immediately taxed as ordinary income and subject to payroll taxes. This happens regardless of whether you sell the shares or continue holding them. Any subsequent appreciation or depreciation is treated as capital gain or loss. A common exam trap involves vesting schedules. Both ISOs and NQSOs typically come with vesting periods, but the tax treatment questions often assume full vesting. Pay attention to whether the question specifies a vesting schedule or not. Another frequent mistake is confusing the holding period requirements for ISO's qualifying dispositions. Let's work through a practical example. Imagine an employee receives an ISO to purchase 1,000 shares at $10 per share. The current market value is $15. 3 years later, they exercise all options when the stock price is $25 and sell 6 months later at $30. This would be a disqualifying disposition because they didn't meet the 1-year holding requirement after exercise. The difference between the exercise price and fair market value at exercise would be treated as ordinary income, and the additional appreciation would be short-term capital gain. For exam success, remember these key points about stock options. ISOs must be exercised within 10 years of grant and within 3 months of employment termination. The exercise price must be at least equal to the fair market value at grant. There's a $100,000 limit on ISOs that can become exercisable in any calendar year. Watch out for questions about early exercises. Some plans allow exercise before vesting, which can trigger different tax consequences, and Section 83B election opportunities. The exam might test your knowledge of this specific scenario. A strategic consideration that often appears in exam questions involves exercising options near year end. With ISOs, exercising late in the year pushes the AMT impact into the next tax year, giving more time for tax planning. Remember that stock options are just one piece of the broader compensation planning puzzle. The exam may ask you to evaluate stock options in the context of an employee's overall financial situation, considering factors like diversification, risk tolerance, and cash flow needs for exercise. These concepts are essential for the CFP exam, but they're also crucial for real-world financial planning. Understanding the nuances between ISOs and NQSOs will serve you well both on the exam and in your future practice.